All right, well, how's everybody doing? I figured after the day we had in the market today, I better make another video. Just because, again, things are unraveling. And again, I don't want to say that this is it, but the 10-year yield broke above 4% today. There was a massive turnaround in the market. It was up in the morning and then it ended very sharply in the negative. And there's a lot of things being floated out today that are very interesting, specifically from the Federal Reserve. So what I want to cover is basically the absolute idiocy of, the people in the banking system and specifically the Federal Reserve. Not even idiocy, they're manipulative and they want to tell you a story that sounds pretty, but at the end of the day, it's super ugly. So the first thing I have is Fed's George, and I don't even know who this George is. Probably not very looking of a guy, but that's fine. Fed's George, pace of rate hikes needs to be balanced against the state of the economy, financial markets. So he's the economy and financial markets. Now, anybody who has studied monetary economics knows that the Federal Reserve has a dual mandate: stable prices and employment. Stable prices and maximum employment. I even wrote that down. I forgot it. It's been a while since I've been in class, but stable prices and maximum employment. So why is it that Fed's George says the pace of rate hikes needs to be balanced against the state of the economy and financial markets? Now, if the Federal Reserve were really a objective caretaker of the economy, they wouldn't care about financial markets. But that's what you can't know. You can't know that the economy is totally dead and the financial markets are simply a tool to make the economy look a certain way. So when stocks are going up, everybody that doesn't really see the economy for what it is, they think, oh, it must be good. Stocks are going up, right? So in order for the Federal Reserve to maintain the fallacy of a real economy, they must maintain higher stock prices. Okay, so that is one of the most important things to understand about that. And I just thought it was really interesting that he came out and said that. Now, obviously, the Federal Reserve has a trading desk. They buy the market all the time or sell the market, on occasion. And they manipulate all global markets, whether it be debt, whether it be Forex, and whether it be stocks. Because it's all part of their agenda, and they will use whatever tools they have in their toolbox, just as a mechanic uses every tool they have in their toolbox, or a carpenter, or a computer engineer, So that's the first thing I wanted to get off. I had a couple more things written down here. What did I talk about yesterday? I talked about how bonds are just as risky as stocks. And the classic 60-40 portfolio is not where you want to go. Well, I don't know if it's a coincidence. Maybe I am psychic. Maybe I see things that, other people don't see. But today I saw literally two headlines saying the exact same thing. It was like I spoke to these people. So MarketWatch says, it turns out that bonds may be a riskier investment than stocks. Oh, I mean, it's not that hard to figure out if you understand the financial markets. And I don't blame anybody, because nobody is taught in school what the financial markets are. Nobody is taught in the media what financial markets are. It's extremely difficult to get this information. Really, most of it is buried in books that were written decades, sometimes 100 years ago. My favorite being Murray Rothbard's America's Great Depression. And I can't say I finished the whole thing, but Ludwig von Mises' Currency and Money and whatever, I don't know. It was his textbook on monetary theory. And I've read most of Murray Rothbard's books other than that, For a New Liberty, Anatomy of the State. And so so again, there's not many places to get this kind of information, but here they are kind of putting it out in the open. I don't even think people grasp how profound that kind of statement is, to say bonds are riskier than stocks. That is the entire paradigm flipped on its head. And they're not going to tell you how stocks derive their value from bonds. That they're still posing this as like separate assets, really, and they're not going into depth. But I thought that was interesting. And then Market Watch. Classic 60-40 investing strategy sees worst return in 100 years. Well, that was exactly what I was saying yesterday. Why would you want to be in the 60-40 strategy? They're both going down at the same time in an epic way. And I mean, I can't say commodities have been performing great either, but of course, hedges on the market and short positions have been performing quite well as well. So you can roll those over into commodities. You can roll those over into another strategy for hedging. So that was the thing today. And just to do a more of a market overview of the action today, very volatile. We got the first round of bank earnings out. JP Morgan, reported some good earnings. Morgan Stanley didn't perform, but we're kicking off this earnings season, and personally, I don't see it going very well, because the market, it may be anticipating some of these negative results, but even if they come in good, you have a lot of the risk floating in from higher interest rates, the 10-year yield above 4%, and global yields rising again in England and Europe. So that's not good. But it's like confounding factors. When the market realizes how much the economy is really contracting right now, the amount of stimulus that would be required to offset a bad earnings season, which is what I would predict, and all these other factors in the debt markets, it could be very catastrophic for the stock market, as we close into the end of the year, into this last quarter. Now, I don't know what's going to happen, because I meant to write this down earlier, but we did see the Federal Reserve, the same George guy, I think, talking about they need to make sure, they don't kill employment by raising interest rates too high. I think it was something like that. But, I would still expect at some point central banks to step in here before it gets too ugly. But I would say it's going to get worse, and then they'll step in, but then it'll continue going downhill, because that's what the trend has been recently. The Bank of England stepped in, stimulated markets up a little bit, and then that kind of wore off really quick. So it's like, even in the last month or two, it's more and more and more that's needed to keep this market afloat. And so it's going to be epic measures at one point, but then it's going to fade off again. So really significant end of the year coming up. Really significant next week we have coming up, with how much markets have been volatile, where yields are. The above 4%, we haven't seen that I think since pre-2008. So that is just something to watch for, and I will make sure to keep you updated on this. So I wish you good luck, have a good weekend, and talk soon.